everyone. Thanks for joining in. Glad to be here and talking to you and EduFund investors. Our pleasure totally.
Yes. So first of all, I would like to congratulate you on the launch of a new fund and definitely all the very best for the NFO. I'm pretty sure Tata is going to do very well on the mid-cap space. Having said this, the market has already momented well and you can definitely expect a good traction in this space. So Shelly, just to begin with, one thing which I had in mind, when I was researching on the Midcap 150 space, I divided into two zones, pre-COVID and post-COVID. So I saw there's only one fund which was tracking the Nifty Midcap 150 index pre-COVID, and post-COVID there came almost majority of the funds came post-COVID. So why did Tata Mutual Fund decide to launch a Nifty Midcap 50 index fund at this point in now, and especially when you already have a Momentum 50 version of the same universe?
Yes, you're right. Midcap 150, we already have a Momentum 50 fund on the Midcap 150 universe. Then we have factor funds, which is your Momentum Alpha, low volatility, quality, and those kinds. And then the third bucket is sector and thematic funds. So anyone who is capturing the passive space should be having funds across the three buckets. Now, it is possible that there could be a year which is, more tilted towards incremental allocations to sector or thematic, like we saw in calendar year 2024. And we saw the entire year was quite thematic and, and more launches also came in there, flows also came in there. How this year has started, calendar year 25, you are seeing more flows in market cap oriented and diversified indices and broad market indices. Having said that, momentum has done very well in India over the last 15-20 years data if you look at it, and there could be periods where momentum gets broken, but overall, as India is a growth country and there's a growth market, momentum would tend to do well over long periods. But there was a time the last 6 months where quality was expected to do well for its own reasons, and quality came in to the play. So even within factors, there was a little churn. So momentum is one factor which largely tends to do well in the bull markets, and quality outperforms in the sideways or the down market. So likewise, when markets change, you have a shift coming in within factors also, but ideally a client should have presence across all the three buckets. Now this year, as I said, market cap oriented funds, our broad market funds are more in focus, and flows are also coming in there. Within that, large cap, mid cap, and small cap space is the three large spaces within the market cap oriented passive funds. Large caps, we already have Nifty 50. And Midcap 150, the plain vanilla version, the original market cap version, we thought to come in for various reasons. One, midcaps sit very well, very beautifully between large caps and small caps in terms of they do have the stability of large caps, but they tend to have a higher earnings growth as compared to large caps, and they are less volatile than small caps. Those small caps earnings growth could be higher, so they sit very well. You have a lot of leaders sitting in mid caps. That's one part. Second is whenever there is a fiscal spending uptick coming in from the government. So whenever there is a boost to fiscal spending, you see a lot of sectors in mid and small caps doing much better, and which is why midcaps capture a lot of those sectors which benefit from government spending, let me put it that way. So over the next 3 to 5 years, or over the next many years, we feel that midcaps will have a benefit of the focus on manufacturing, focus on defense, focus on PLI, and so on and so forth. So they have corrected. The premium to large cap was about 60-70%, which has come down to 30%. It still is at a premium of 30% to large caps, but because of these reasons, we feel mid cap as a space should be captured, currently, and that is why we thought to come with this and fill our market cap oriented, spaces with mid cap 150 index.
So Shalini, from a very layman's perspective, now I have two options: to invest in Momentum 50 version or the plain vanilla version. So what would be my rationale in choosing which?
See, momentum considers the price differential. So it's a factor. It's just another lens. For example, active investing is one approach to investing and passive investing is another approach to investing. So it's not a 1-0 game. It's not either or. What we've been saying, if you have to capture a pocket of the market, either a sector or a theme, or even a broad market, both the routes, are a good diversification to each other on judgment and discipline, both. So that's how we look at it. Active, let's say active. It's not active versus passive. It is active and passive. Now, similarly, within passive, factor is one lens. Momentum is a factor. It's part of factor investing. It is one lens, or it is one approach to investing. Market cap is another approach to investing. And when there is a time, then sector and theme, is another approach to investing. So, Midcap 150 index fund would fall into the market cap bucket, and momentum would fall into the factor bucket. Now, the universe of this momentum 50, of course, is Midcap 150. Yes, momentum considers the price 6 months and 12 months price differential and captures those stocks where the rule or where the index finds the price differential to be the highest. It could be more tilted towards 1 or 2 or 3 or 4 sectors. That's another part. Now here in this, we've put stock caps of 5%. So from that perspective, Momentum 50 portfolio is also very, very diversified. However, it is the factor lens, and it will go and look and scan the market for all those places and all those pockets where the price differential, 6 months and 12 months price differential is the maximum. Now, Midcap 150, that's the overall midcap space. The unique part is the number of, basic industries or the number of sectors which are different, which are unique. For example, Midcap 150 space has higher exposure to capital goods, chemicals, realty, and healthcare. Whereas, the Midcap 150 space has lesser exposure to financials as compared to large caps, I'm saying. Financials, FMCG, oil and gas, power, construction, IT. So midcaps have a very unique positioning to what they hold in themselves. And this unique exposures benefits a lot when fiscal spending and government spending come in. So from that perspective, it is a overall broad market exposure which we are taking through Midcap 150, and we are expecting, yes, the valuations are, they have corrected, but they are higher as compared to large cap. So that is why we think that momentum is one way, it's one lens, one factor, but Midcap 150 as an overall broad market should be taken exposure to once you already have your Nifty 50 and Sensex index funds in place.
So, pivoting on to what you said, you expect, good traction in the mid-cap space for next 5 to 7 years. So, how do you view India's mid-cap segment over 5 to 7 years, both in terms of opportunities and, of course, risks?
So our house view coming in from the investments team is that, large caps are, of course, let's say the earnings growth there, you can expect about 10 to 12% earnings growth for the next, 3 years. And, last 5 years, so if you see last 10 years and if you see last 5 years data for both large caps and mid caps, you would see the last 5 years are, the earnings are higher as compared to the average. And so next 3 to 5 years, we expect earnings growth in mid-cap space to be between 15 to 17%, whereas large caps to be, let's say, between 10 to 12%. Valuation-wise, always mid-caps, have traded premium. Now, the premium has come down right now, but it has traded premium because, there is a lot of conviction in the growth opportunities in mid-caps, and the market is okay to pay that multiple there in mid-caps, and that has sustained. Also, one important point about when we compare mid-caps and large caps is that the ownership of promoters and FIIs, if you compare that large cap and mid cap data. So large caps are about 288 to 80 lakh crore market cap, and mid caps are about 80 lakh crore market cap. So value wise also and percentage wise also, FII ownership is less. Promoter ownership is very high, is higher at 55% in mid caps as compared to about 47-48% in large caps. So from that perspective, this is how mid caps are positioned, and for the next few years as well.
Yeah, this very well put up. This already convinced me to stay invested in the mid-cap segment for the next 5 to 7 years for sure. So now, Shelly, coming back to the entire universe of the mutual funds. So as you already know that several AMCs already have funds offering the Nifty Midcap 150 index.
Mm-hmm.
So as an individual investor, how should investors evaluate and compare different schemes? What would be the parameters?
See, in general, passive scheme should be compared with the, the liquidity and current AUM. AUM beyond a point does not matter a lot because you already have a lot of buyers and sellers as part of that AUM, so that the activity on the exchange, if it is an ETF, can go on. In case of index funds, also because it is not trading on exchange, it does not matter. But yeah, it's good to have a largish, AUM or reasonably fine.
Correct. I guess the three parameters that definitely make a fund very attractive. So in fact, Shelly, covering to this one part, in fact, I have a curiosity on this as well. So there's a perception that, as the fund size grows, tracking error can increase, especially in the mid-cap space where then the liquidity in the stocks are reasonably low as compared to the large caps. So is this a valid concern or probably just a myth in the market?
As the AUM grows, the subscriptions and redemptions as a percentage of AUM, in fact, is lesser. So from that perspective, the tracking difference and tracking error, so once the tracking difference comes down or is lower and is maintained, then tracking error automatically will be lower, because tracking error is nothing but the standard deviation of the daily deviations. So how volatile the daily deviations are. Also, we are making a lot of efforts towards automating this, index mirroring and replication, and a lot of other operational activities which would help us bring the tracking difference much closer, in fact tracking difference much lower, and bring the performance of the index fund much closer to the performance of the index itself. So automation, as the portfolio of AMCs grows in terms of the number of index funds and ETFs they manage, this kind of automation brings in a lot of efficiency. Operational efficiency is very much required here. So that piece now with our automation piece already kicked off, is being taken care of well. That's one. Second is on the liquidity side. As I mentioned earlier, the liquidity profile discussion between large caps and mid caps was a discussion earlier, not right now, as overall market cap has also grown. So 33,000 crores to 1 lakh crores is a mid-cap space. So that's a reasonable liquidity, situation. Number of stocks are not very high to replicate. 150 is the number of stocks, not very less as 50. But yeah, so 150 number of stocks is also not very high to replicate from that perspective. So overall, and with this, again, the automation helps here also. You can replicate a larger number of stocks, with this automation. So I think overall we sit pretty well from that perspective on the operations bit as well.
So now this also puts up one thing. So, will this fund participate in equity derivatives or probably stock lending to add probably an alpha for the investors?
No, our endeavor is to replicate the index as it is. We do not want to deviate, barring some bit of cash which is maintained because of the expense ratio. That's about it. Otherwise, we do not want to deviate from the index on a daily basis at all. Yes. And reconstitution and rebalancing is the only change which happens, which is announced, and we have to do it on the effective date. Yes.
So just actually ending up this up, what are some common misconceptions about passive investing in mid-caps that would you like to clarify?
Okay, overall myths in mid-caps, or rather let me first spell out the overall myths in passive investing. So passive investing returns would be lower than active. This is in general. The canvas is just active and passive discussion, which I have just picked up. That's not the case, because passive is rule making, active is judgment. Now, the important thing to note is which part of the market are you going and making a rule on and creating an index on. So, for example, in 2024, let's say a capital market index yielded about 70 to 75% return, whereas a financial services index yielded about 10 to 14% returns, and a bank index yielded about flattish returns. Everything is financial services, and probably you could compare that with an active fund also. So I'm saying within passive also, I'm keeping the active aside right now, within passive also it depends. If you've chosen a piece of the financial services market, you were at 75% calendar year 24 returns. If you had chosen financial services overall, you were about 10 to 14%. And if you had chosen one large piece of the financial services, you were flat, 1-2% banks. But the idea is to take two approaches. Because in active it is judgment. You are taking overweights, underweights, and if those calls go right, obviously there would be alpha. Here you are capturing the entire space. Because it's a larger space. Let's say PLI impacts 14, sectors, and each sector should have a decent representation. If you want to take all representation, and if midcap is one space which captures a lot of the PLI spaces, it's good to go the passive way also. So one can diversify between the passive and active route. But when it comes to returns, that is comparable. But always passives will be lower than active because it mirrors the index. Now, an important question to think and ask is, which part of the market are we talking about in passive? It could be, if it's a theme or a sector, it could be higher in a particular period than overall actives also. So it depends. But the risk could also be quite higher. Here in a diversified fund, you are actually taking only systemic risk. Because it's a broad market risk. You're taking market risk largely because it's covering 18 sectors, 19 sectors. But when you're going and making a rule and a passive fund on a very small part of the market, you're actually taking unsystemic risk. So from that perspective, risk reward is what you need to see overall.
Definitely, Shani. So it also brings to the point that an investor by its profile should always be diversified, probably from active and passive, and probably across different schemes as well. So that was one of the key, because it helps you mitigate the risk as well as adjust your returns as well.
So core, satellite, and within core, you could, split between active and passive. And within satellite portfolios, also you could split between active and passive, like a banking sector, or, you could take through an index fund as well as a active banking sector, financial services, equity fund. That's how. So core, satellite, and underneath core, satellite, it could be a good split between active, passive. In large caps, the split could be more in favor of passives. Maybe it could be 60-40, 60 in favor of active and 40 in favor of passives. In others, it could be 80-20. It could be 80 towards active and 20 towards passive. So that can vary. But under core and satellite portfolios both, you should have a mix of active and passive. That's how we look at it.
Yeah, thank you so much, Sherry. Now it's up and ended to our conversation. Thank you so much for having us on space and definitely clearing thoughts on Tata Nifty Midcap 5150 Index.
Thank you, Srimohan, and thank you to the entire team of EduFund, and happy selling to you guys. And thank you, investors of EduFund, for spending your time listening to us. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.